SpaceX is preparing to go public, aiming to raise $75 billion at a total valuation of $1.75 trillion. When it hits the market, it will be the largest initial public offering in history. To put that in perspective, this massive offering is nearly 3 times larger than the previous public record holder, Saudi Aramco. Based on his 42% stake in the company, this transaction is set to push Elon Musk's net worth past the $1 trillion mark. But buried in their S-1 filing, the massive document companies must submit to the SEC before going public, is a difficult math problem. SpaceX is deeply unprofitable, reporting a $4.94 billion net loss last year. The math gets even harder when you compare the asking price to the underlying financials. The IPO aims to price the stock at $135 per share. Independent equity analysts calculate a fair value of just $63. Investors are looking at a $72 gap per share. To make up that difference, they have to place an incredibly expensive bet on some highly speculative, unproven technologies. If we run SpaceX through standard financial modeling, we can separate the hype from the reality and figure out exactly what that $135 price tag actually buys. First, you get their core business, the Falcon rockets. SpaceX currently holds a virtual monopoly on the commercial space launch industry. Second, you get Starlink. Their massive constellation of internet satellites provides a reliable, steady stream of subscriber revenue. Modeling the future cash flows of those two proven sectors, the launch and connectivity businesses, combined only contribute $40 per share. But look at the remaining gap. Even the greatest aerospace operation on the planet barely covers a third of the $135 asking price. To justify the rest of that valuation, Wall Street has to look way past the launchpad and into the extreme unknown. The first unproven variable is Starship. To meet future revenue targets, SpaceX has to achieve rapid, reliable reusability with the spacecraft, an engineering hurdle years away. But the real financial weight of this IPO is resting on an even more speculative concept: orbital AI data centers. Down on Earth, the artificial intelligence boom is hitting a physical limit. Massive AI supercomputers require immense power grids to run, and intensive, expensive water cooling systems to keep from catching fire. SpaceX's proposed solution is to simply put those servers into orbit. They want to build giant data centers on satellites, running on unlimited solar energy and using the freezing vacuum of space for free cooling. This Morningstar probability chart breaks SpaceX's valuation into 3 weighted scenarios. On the right, they assign just a 7% probability to the moonshot scenario, which assumes SpaceX successfully scales these orbital data centers and captures major global AI computing by 2040. Independent models treat this outcome as highly improbable, but if you pay $135 a share, your investment relies on treating it as a guaranteed reality. On top of the speculative tech and the multi-billion-dollar operating losses, there is the corporate structure itself. The SpaceX IPO uses a controversial dual-class share structure. This setup grants Elon Musk over 80% of the voting power, despite owning a much smaller share of the equity. That mathematical firewall makes him completely immune to being fired or even pressured by public shareholders. If you buy this stock, you are legally locked out of controlling the company's direction, but you are still footing the bill for those massive annual operating losses, and those losses will likely continue. Because Musk's ultimate goals for that capital go far beyond Earth-based telecommunications. He plans to fund the extraction of raw materials from asteroids and eventually the colonization of Mars. Buying into the SpaceX IPO is a completely different proposition than a traditional investment in a profitable company. You are taking a massive financial leap of faith to fund an unfireable CEO's distant vision of humanity's future and crowning him the world's first trillionaire in the process.